Hi there, welcome to Kneppy Invest. One of the benefits for me doing this channel is I do see a fair few ideas being raised by viewers of this channel. And that's one of the reasons I started this particular video series looking at financial year 23 results, viewer suggested edition. So I asked the viewers of this channel to give me some companies they'd like me to do a financial year 23 video on, and I am going to do a video on every single suggestion, including the company I'll be featuring in this video, Red 5. A company I have not looked at before, and more than likely, if this company wasn't suggested, I probably wouldn't have looked closely at this company. So it's really interesting to delve a little bit more deeply into a company I otherwise would never have had a look at. And Red 5 is a little bit interesting. Will I now think about taking a position in this company? Probably not. But for those gold bugs out there, this is a potential interesting gold play. And in today's video, we're going to delve into what this company, well, the projects this company has, look at their financial year 23 results. I'm also going to have an interesting look at their financials as well. So let's go on the Red 5 journey, starting with what this company or what projects this company has. But before we start that journey, let's have a look at the next 5 companies I'll be featuring in this particular series, or viewer suggested. Next company will be ARB Corporation, a company I don't think I've ever owned in the past, which is surprising. Then we'll have a look at Johns Lyng Group, company I own currently. Polynovo, company I never owned. DGL, a company I have owned in the past for a short period of time. And then Laser Bond, a company I own right now. In fact, I've owned that company on and off, but right now I hope to own Laser Bond for a longer time because I do think it has the potential eventually to become a high quality company. It might take them 5, 10, even longer to get to that point, but I think Laser Bond can achieve that. Even though I had done zilch research on this company, I still knew Red 5 was a gold producing company. For some reason, I knew that. In fact, there are quite a few companies on the ASX I have done no research, but I still know what they do for some reason. It could be just because of podcasts, that sort of thing, and people just talk about these companies that I've done zero research on. So Red 5 is a gold producing company. They have 3 assets in the Eastern Goldfields region of West Australia. So if you go northwest of Kalgoorlie, there is the Goldfields Highway, which is appropriately named, a town called Leinster, and both these companies' projects, well, all 3 of these companies' projects are near that small town. The first and probably biggest project this company has is the King of the Hills gold mine. They also have the Darlot gold mine and a royalty net smelter over the Tiana gold mine. Now, Red 5 established the King of the Hills processing hub in 2022, so I'm talking about 1 year ago, with a large 4.7 megaton per annum process plant being fed by the open pit and underground mines at the King of the Hills and an underground satellite mine at Darlot. In June 2022, Red 5 completed the successful construction of the King of the Hills process plant. First gold was produced on the 5th of June 2022, so just over 1 year ago, and the company is ramping up to full production ramped up the full production in the September quarter 2022. So the King of the Hills gold mine, if you look at the mineral resource and the ore reserve, it makes it one of the top 10 largest mines in Australia by ore reserve. Now, the open pit has a forecast mine life of 16 years, and the underground mine has initial 5-year life of mine, which probably more than likely will expand further with more exploration. Steady state production is expected to be around about 200 kilo ounces per annum. Now at Darlot, another mine they have, the underground mine has been transformed into a satellite ore feed for the King of the Hills. They're about 100 kilometres apart, and the process plant at Darlot has been placed into care and maintenance. Now to the financial year 23 results for this company. I'll also talk about some interesting things I found in the financials. So points from their profit and loss, their balance sheet, and the cash flow. So wait around for that. I'm not sure when I'll mention all those things. Maybe I'll put those little interesting nuggets through their financial year 23 results. Now, Revenue, a significant increase from last year, from 165 million to 422 million. 422.7 million. So more than likely that is because of the King of the Hills going into gold production. More than likely that is true. Profit, well, negative. So this company is loss making right now, and this is where it does become interesting. But last year they had a loss of 56 million. That is down to negative 8.7 million. Now, when I went through the profit and loss, I did notice that this company had $21 million of financing expenses, including interest expense of about $18 million. You can find that in note 5B. So if this company didn't have any debt, this company would have been profitable by at least $10 million. Gross margin, 6.6%. And you would assume the company would want to increase that over time. The company is operating cash flow and free cash flow positive. Operating cash flow positive, 46.7 million. Free cash flow positive, 17.1 million. And now another nugget. I did have a look at the cash flow statement, and Red 5 did spend $29 million on capital expenditure, which is why there's a $29 million difference between operating cash flow and free cash flow. And the company also spent $96 million on mine development. So they did burn through a lot of cash. And maybe this is one of the reasons why the company did 2 capital raisings during financial year 23, a $60 million capital raising in October of last year, and then another $90 million capital raising in February of this year. I'll talk about that in a second. And currently the company has net debt of $82 million, and that also includes cash and bullion. And the company really wants to get that debt down, because financing expenses, interest expense are quite high. And if they didn't have the interest expense, this company would be profitable right now. In fact, one of the reasons they did raise capital was to repay or get that borrowings down. In fact, they repaid in the financial year $47 million of the loan. So they've already started the journey of decreasing that debt. One thing I like to look at for all mining companies is just how much gold they produce, sold, also all-in sustaining costs, and also the average price achieved for selling the gold is very important as well. I'm not as concerned by the financials. I just want to look at the production, and also looking at the financial year 24 guidance. So let's focus on those 2 things in this particular slide. So gold produced was significantly higher than last year. In fact, almost 100,000 ounces up from last year. And remember, they want to get to about 200,000 ounces per year. Gold sold is almost the same as gold produced. Now, all-in sustaining cost, this is where it becomes really important. A significant decrease in that over the past year. And if you compare the all-in sustaining cost to the average price achieved in financial year 22, there's not much difference. That's one of the reasons why this company was not profitable last year, because the difference between the price achieved and the all-in sustaining cost was about $47. Now it's up to about $700. So a little bit more margins in there, with all-in sustaining costs down from $2,479 to $1,837. Now let's have a look at the financial year 24 guidance. So they are expected to increase their production up to their aimed amount per annum of between 195 and 215,000 tons. And interesting enough, they do expect all-in sustaining costs to be a little bit higher than this year or last year. So on the low end, about 1,850. That is a slight concern I do have, but not an over concern. So not a cost blowout at all by getting the gold out of the ground. Not sure what that growth is. So they have a growth section here, Australian dollars in million, 40 to 46. Is that profit? Is that EBITDA? I am not sure at all. Probably wouldn't be the EBITDA, because EBITDA this or last year was 96.1 million. I'm not sure what that growth is. The company has 3.46 billion shares on issue, and the shares on issue actually increased by over 1 billion because of those 2 big capital raisings the company made or achieved, whatever you want to call it, in the past year. Now, the market cap of the company is 1.14 billion. That's our share price of 33 cents, which is interesting because I actually compared this company to a few other mining or gold mining companies on the ASX that has similar market cap than that. And funny enough, when I went through the company's presentation, they also compared Red 5 to these other gold producing companies, in particular Capricorn and Gold Road. And I'll talk about those 2 companies later in the video. Equity, significant increase in equity from 182.8 million to 330 million. So how does a company increase equity? Well, one of the ways is to be profitable. Another way is to raise capital. So the whole reason why equity increased by 150 million is because they raised about $150 million of cash through those two capital raisings. Now, return on equity, return on capital, and dividend yield are not applicable for this company because this company is not profitable and they don't give their shareholders their dividend just yet. I'm not sure why I'm showing you the valuation metrics for Red 5 because you can't really understand if this company is cheap or expensive by looking at these numbers. And of course, the PE ratio is not applicable because the company is not profitable. Price to book ratio is 3.45, EV to operating cash flow 25.7, and none of those numbers really tell me anything about Red 5's valuation right now, particularly if they increase their production in the following year up to where they expect. And if they actually improve their all-in sustaining costs, this company could be highly profitable in the next few years. For laughs, I did a reverse TCF. What would the operating cash flow have to increase from year per year to justify the current valuation? And that was a 16.2% increase. So definitely the company can achieve that. I don't see why not. For those who know anything about me, I don't like debt. And we can see that with Red 5's financial results. If they didn't have debt, this company would have been significantly more profitable. Well, they weren't profitable at all, but they would have been profitable if they didn't have any debt. So they do have a plan on how they are going to, well, when they're going to pay down their debt. So they're going to pay down their debt slowly over the next few years. From $128 million in June of this year down to $3 million by June 2026. Of course, there are some factors that are going to play a significant role in how fast they can pay down their debt, including gold prices, also including all-in sustaining costs, and also how much gold they can get out of the ground. Now, this is another slide. I'm not sure why I'm showing it because this is looking at the revenue and profit history of this company going back to 2014. Now, this company has had revenue for the last 10 years, or about 9 years or so, and the revenue has been climbing through time. And that is actually what I'm looking for when I research every company. And of course, there was a massive increase in revenue from last year to this year. Most years, the company has not been profitable, but profitable is up and down with Red 5. And more than likely, if they can increase their production, get to where they want to be, this company will become profitable and also generate free cash flow. And that's exactly what shareholders want from a company they own. Now, this is a much more interesting slide. This is actually from Guru Focus. The previous slide was from Ticker, but I like this slide from Guru Focus, which is looking at the shares outstanding and the market cap of the company since 2014. So the solid black line is the shares on issue and the red line is the market. And the market cap of the company has increased significantly over the past 10 years. In fact, 10 years ago, the market cap of this company was below 50 million. Now the market cap of this company is above $1 billion. And the way the company has increased their valuation is to do a multitude of capital raisings. In fact, if we go back to 2014, the shares on issue was about 500 million. Now it's above 3 billion. The shares on issue have increased sixfold over the past 10 years. But that is to be expected for these type of companies. In fact, the main reason many companies list on the ASX is the ability to attract capital into their company. So to grow, that's why they want capital, is to grow in the future. And that's exactly what Red 5 has done over the past 10 years. The market cap of this company has increased from about 50 million to 1.1 billion. But that does have an effect on the share price. So if the company significantly increases shares on issue, and even if the company's valuation has increased, the share price may not have increased as much as a valuation. And sometimes, and this has happened a few times, even if the valuation of the company has significantly increased, the amount of shares on issue has increased so substantially, the share price actually drops through time. And I'll talk about that again when we look at the chart of this company. Now, one particular slide I like when any company releases any sort of presentation is a comparison of that company to other peer-like companies on the ASX or sometimes around the rest of the world. So in this particular slide, Red 5 compared the EV to reserve and the reserves to about 10 other peer-like companies on the ASX: Ramelius, Bellevue, Silver Lake, Calidus, Westgold, Gold Road, Capricorn, Genesis, and Regis. And what they're saying is potentially there is some nice value in Red 5 right now compared to their peers. Not much value when you look at this particular chart. In fact, I told you I did compare this company to Capricorn and Gold Road, and there's not much difference in valuations between those two companies. A little bit, but not much. In fact, very little difference in valuation between Red 5, Regis, Westgold, Silver Lake, and Calidus. Now, one of the things I looked at, apparently this is the valuation, I've just noticed it, the valuation of WA-based gold companies. So a true look at peers of this company. It says bubble size equals enterprise value. Anyway, I also compared all-in sustaining costs of Red 5 to Capricorn, Gold Road, and Regis. Now, I knew Capricorn had a really low all-in sustaining cost, and for the full year, that all-in sustaining cost was 1,208. For Gold Road, which I have not had a look at before, in the last quarter, it was 1,620. And for Regis, 1,805, which is fairly similar to Red 5. But if you're just looking at all-in sustaining costs, and I think you do have to look at all-in sustaining costs, Capricorn Metals seems to like it is the winner out of these peer-like companies. Now let's have a look at the charts. First chart here is the weekly chart going back to, well, 10 years, so late 2013. In the next slide, we'll look at the daily chart going back about a year or so. So remember, in 2 slides ago, I said this company had increased their shares on issue from, what was it, 500 million to 3 billion, and the valuation of the company had increased from below 50 million to 1.1 billion. So if this company didn't raise any capital, increase their shares on issue, this would be a 20-bagger just based off valuation. But because the company has raised a multitude of capital and shares have been absolutely diluted sixfold over the past 10 years, that means the share price should not have risen by 20 times. And it hasn't. In fact, the share price has risen from about 10 cents to 33 cents. So only about a 3-bagger for shareholders over the past 10 years. But still, I would love a 3-bagger for my shares in a company over a 3-year period. So it has been a successful journey for shareholders of this company over the past 10 years. Before this company was nominated as a suggestion in this particular series, Red 5 did come onto my radar simply because of this particular chart. The share price of Red 5 had moved into an uptrend in late August, early September, and the share price has kept on climbing. So the uptrend is intact. There is some nice positive sentiment in this company right now. So this particular daily chart goes back to October of 2022. So remember, this company did 2 capital raisings last financial year. A $60 million capital raising in October, and also a $90 million capital raising in late February of this year. So that $90 million capital raising was at a share price of 13.5 cents. And that was almost a few-year low in the share price. That was the time to buy. One of the reasons that might have been a time to buy is because more than likely, because the company did 2 big capital raisings in a row over a short period of time, more than likely the company wouldn't need to do another capital raising for a few years, if at all. So that was a low in the share price of this company. And in fact, the share price of a company has moved from 13 cents to 33 cents over a 10-month period. So almost a 3-bagger in that time period. So that's a nice return for shareholders during that period. That's all I have for this look at Red 5's financial year 23 results. Was I blown away by what I found in this company? And to be honest with you, probably not. But in saying that, the chart does look nice. And that's one of the reasons I was not following this company too closely, but I had put this company onto my uptrend watch list because the share price was in an uptrend. And the sentiment around this company has turned around, particularly from that capital raising in February of this year. So it seems like maybe that's all this company will do in terms of capital raisings, unless they do a significant acquisition and that sort of thing. So I like to see how this company does perform in financial year 24. And it wouldn't be surprising if this company becomes profitable, operating cash flow and free cash flow positive, and they really start paying down their debt, particularly if gold keeps on increasing in price. So if you have any questions about Red 5, maybe any other gold producer companies in West Australia, maybe that you do prefer, Capricorn Metals, maybe Regis, Gold Road, love to hear your thoughts on these gold producers. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own needs. That's it for this video. Have a good day. Bye.